Four investing experts, decades of experience, and they all said the same thing. Making money comes down to these three mistakes that all investors make, even the experts themselves. Hey Bowtie Nation, Joseph Hogue with a video that will change your life. I asked four investing experts, Jaspreet Singh of the Minority Mindset, Marco at Whiteboard Finance, Mark Rusin, and Kieran of the FinTech channel, what are the biggest mistakes you see investors making over and over again? What I heard were the same three wealth destroyers, three mistakes that, if you understand how to avoid them, you will surpass your financial goals, retire early, and never have to worry about money again. Now let's get started with that first mistake, one I heard from every single expert, one even they fall into.
Stop doing what the majority of people do, because the average person is coming in, reading something on CNBC, reading something on Reddit, reading something on ChatGPT, blowing their money into some stupid stock because they heard some person talk about it on the internet. They buy it when it's at an all-time high, and then the markets start to go down because, well, markets are volatile, especially now, and then they panic sell, and then they wonder why the system is rigged against them. Don't do stupid things.
So I was a kid. I was 18 in 2006, and I was buying what a kid would buy. Oh, I play soccer. Let me buy Nike, shares because I have Nike soccer cleats. So I have an iPod. Let me buy some Apple shares, right? And then you get your teeth kicked in 07, 08. Everything's down 30, 40, 50%. You're like, this sucks. Why am I investing, right? And then you panic sell. So I think the biggest mistake that a lot of people make is that they don't know why they're investing in the first place. And then they panic sell when the thing, whatever that stock is, goes down.
And Marco's story is exactly how panic selling, our first investing mistake, really starts. He wasn't buying companies because he understood the business. He was buying Nike because he wore Nikes, buying Apple because he owned an iPod. When the crash hit, his stocks got crushed, and suddenly he had no reason to keep holding. Panic selling is selling an investment because fear becomes stronger than that conviction. It's when the stock price starts making your decisions for you instead of smart analysis. And Jaspreet hit on the second piece of this, that most investors buy a stock because someone on CNBC talked about it, because it was trending on Reddit. The problem is that when you borrow someone else's reason to buy, you're also going to borrow a reason to sell. And let me tell you folks, for every stock, there is always someone screaming, sell, sell, sell. So how do you stop this panic selling? First, you never buy a stock without writing down exactly why you own it. It doesn't have to be a full-on book, just a few notes on why you think it's a good company, what the market doesn't see, and why that stock is undervalued. This way, if the stock does start dropping, you can look back on your notes to see if anything really has changed about the story, or if you were maybe just wrong about it. If something has changed or you were wrong, then yes, you need to sell it and put that money back to work. If nothing changed though, and that analysis still points to holding that stock, you might even consider buying more. Another tip here for this panic selling mistake: stop looking at your portfolio every day during those market corrections. Nation, we get at least a 5 to 10% drop in stocks almost every single year, and usually more than one. The best thing to do during these times, other than maybe buying more of those stocks that you still really love, is just do your own damn thing, not watch the market. Like Jaspreet said, the best performing investors are the ones that do the least, not because they're smarter, but because they don't let fear talk them out of a good investment. But then panic selling is only half the problem, because even when investors aren't selling in fear, they're usually doing something just as destructive, something that costs investors over $1 million on average. This chart is from Dalbar's annual survey of investor returns, a study since 1984 that has shown investors underperformed even the average return across the market. The average investor's return of 7% versus just investing in the S&P 500 for that 10.6% annual return doesn't seem like too much difference until you consider it is a difference of almost $1.3 million over 3 decades of investing, and it all comes down to turning the stock market into a casino.
By far the biggest mistake I've made, and it's happened time and time again, is trying to time the market, both a specific industry or the overall market in general. I'll have times where the market feels expensive. I see stuff that seems clearly irrational. And so I'll try to move money out of the market and it'll keep on going up. Then you jump into the market because it's gone up, and that's when it drops, right? Humans just aren't good at kind of discerning these patterns in data without some kind of deeper framework behind it. We're really, really good at seeing patterns that don't exist. And so I think because of that, market timing can catch out anybody. And so that's why I just have a blanket rule now. I don't time the market.
A lot of people, they get the allure of, penny stocks or Nvidia or these high flying tech stocks, and those are fine. A lot of people made a lot of money on those, but I think a lot of people just need to have a mindset shift of this is a wealth building tool. It's not a casino. Okay. So I think once you go down the rabbit hole of, buy my course and buy these 7 penny stocks in my community and this and that, that's when you start to run into some problems, or you start to try and trade, right? Which we know that 90+% of all traders end up losing money or underperforming.
I think the thing that people get wrong is they get panicked and they get emotional. The best investors out there are dead people. There was a study that they looked at brokerage accounts, and dead people's brokerage accounts did the best because they were not selling because they're dead. And so the mistake that people make is that we get emotional and we sell. And what I like to teach is something called poop, because every time bad things happen, poop happens. And poop is panic leads to overselling, leads to opportunity, leads to profit. Anytime something bad happens, people panic, they oversell, which creates the opportunity for the financially savvy to come in and buy, creates the opportunity to profit if you are patient.
Now, Marco said something that gets to the very heart of this overtrading problem. Most investors say they want wealth, but what they really want is excitement. Long term investing is boring. In fact, Paul Samuelson, the first American to win the Nobel in economics, said, "Done right, it's like watching paint dry." Investing is buying a share of a great company, riding that company's earnings higher over years, and just letting that compounding do the work. Against this, trading feels a lot more fun, like you're more involved and you're moving. Every day is a new prediction, a new hot stock, and a new opportunity. The problem is, folks, nobody can do the kind of deep analysis that needs to be done with this kind of day-to-day trading. So you start here doing exactly what Kieran was talking about. You stop analyzing and you start going off emotions, ideas, and those feelings, that gut reaction. The market looks expensive or it feels like a stock is going higher. You've turned the market into just one giant roulette table. The odds are even worse than 13 black. Now, don't get me wrong, there is actually nothing wrong with trading stocks if you're an actual trader. If you're using those charts, managing risk, taking profits and losses according to a defined strategy, it's what tens of thousands of investors do professionally every single day. The problem is that most people call themselves long-term investors and then behave like day traders every time CNBC flashes a scary headline. That is where Jaspreet's poop framework happens. Panic leads to overselling, which creates opportunity and profit, but only for the patient investors that aren't trading in and out of their stocks. So here, I want to give you my rule for stock trading to stop selling out of my stocks too early or even rushing to buy new stocks. At first, no idea or a stock becomes a buy in one day. This isn't for those time-sensitive investments or short-term ideas, but if I hear an idea for a long-term stock pick, I'm spending at least 3 to 5 days researching it, making sure that I've read that bear case against the stock, and then making my own decision. Now, this cooling off period not only gives me time to research, but it also gives me time to think through how much I want to invest. If I want to break that amount down into an investment over the next few months, just in case the stock comes down or all at once, and the reasons that would make me sell that stock. On the flip side of this, I'm never selling a stock in a single day either. If bad news comes out or the company has a bad earnings report, I'm taking at least a day or two to go back through my analysis and ask, if I didn't own the stock right now, would I buy it at this point? If it's a long-term investment, I'm not making any short-term decisions. I'm going to focus on the business, not the stock price, the revenue, earnings, cash flow. If those are still intact, then I'm holding on. And not only will this rule keep you from turning investing into a casino, but could also save you thousands of dollars. When shares of Supermicro Computers, SMCI, crashed 33% to $20 each in March, investors rushed to dump the stock. Now, I argued the upside was still there, that the server maker was still best in its class, and I doubled down. And in less than 10 weeks, shares were up 138%, and I was up $700,000 on that. Nation, that initial reaction to big news, when fear or greed sets in, is usually the wrong reaction. Like Jaspreet said, take a step back, take a breather, and
Don't do stupid things.
I'm going to reveal that third investing mistake next, along with an easy 5-minute framework to analyze any stock. But just as important as the investments you buy is where you buy them. And it might surprise you, I have accounts on 5 different platforms. I use some for research, some for easy automated investing, and for all of them, I got free stocks or cash back when I open the account. Check out the link I'll leave in the description to see a full list of the sites I use, along with special offers and freebies on each. For example, my new account on Public combines the world's first agentic brokerage to help monitor the market and manage my cash with a 1% matching bonus on all retirement contributions. You'll also get free stocks on Robinhood every time someone you know opens an account and can make automated investing easy on Acorns. These are all platforms and sites that I've used and are totally free to sign up and start investing. So look for the link in the description or just scan the QR code here and get your free stock. Back to our investing mistakes, and I like to call this one YouTube made me do it. And nation, I get it. Watching a few videos here on YouTube is like the easy button of investing. Hell, you can get a list of stocks to buy faster than the guy in the cargo shorts at the bar can explain why he almost joined the Marines. But folks, that easy button only goes so far. There are all kinds of investing rules thrown around here on YouTube that will lose your money.
One of the rules that I hear a lot is when it comes to just buying a stock on a dip. Buying a stock because they saw it come down 15% without doing the homework. And the fact of the matter is you're going to get burned a lot of the times if you don't understand how to do the homework ahead of time. And for me, in my investing style, what I do first is I don't actually look at valuation first. I look at quality, because my goal is to invest in high quality assets at great valuations. And when you see a stock come down 20%, it may in fact sound like a stock on sale, but when you actually go look at the results, it's actually a stock where there's margin compression. Sales are starting to slow. Expenses are increasing there. Earnings are slowing down. So it's actually not in fact cheap as you think it is. It might be a stock that's cheap for a reason.
There's all the cliches that sound really good, but don't really predict anything. Don't catch a falling knife. Don't buy at the top. Buy low, sell high. Yes, those are all technically true, but they don't tell you anything about what to actually do in the moment. They're just kind of these fun phrases we come up with that justify an action after the fact, right? I would be a little bit skeptical of any of those cliches. They're fine if you need them to make yourself feel better about a decision you made, but they don't have any predictive power, right? There's no data behind them.
Look, again, I get it. Watching YouTube is so easy, and I am so pretty. Reading a 200-page annual report, not so easy and definitely not as pretty. The problem here is what Mark pointed out. A stock down 20% isn't automatically a bargain. Sometimes it is a bargain. Sometimes it's a business falling apart. And those are two very different things. And if you don't know the difference, you're not investing, you're just gambling. And Kieran there made the same point about investing cliches. Buy low, sell high, be greedy when others are fearful, and fearful when others are greedy. They sound smart because they're intuitively correct, but the problem is they don't actually tell you what to do. In the end, it's just the investing equivalent of masturbation. Might feel good, but really gets you nowhere. Now, the good news is you don't need to memorize the curriculum to the Chartered Financial Analyst designation or spend a decade as an analyst on Wall Street. Doing your own analysis can be as easy as a 5-minute framework that I use before buying any stock. First, you want to check if revenue is growing. Now, you can find these measures on any investing site. Here, looking at analyst forecasts for revenue, because a company that's not growing is one slowly dying from competition. Second, here are earnings or profits growing. Now, sometimes a company cuts its prices or spends more, and that earnings growth does slow. But looking longer term, those profits better head higher, because revenue growth without earnings growth is just expensive optimism. Third check here, is management creating value, and how does that stack up against its competitors? Here you're going to want to look for profitability measures like the operating margin, which is the percentage of revenue left over after paying those input costs, production, staffing, and the marketing, a key measure of how efficiently management converts its sales into profits. Or for this, you can also look at return measures like the return on equity. How well does management turn your stockholder equity into earnings? More importantly, with those two measures, how does the company stack up against its peers? How is it that NVIDIA is able to convert 65% of its sales into those operating profits and book a staggering 114% ROE, when competitor AMD is only able to generate 14% operating margin and 8% return on equity? That comparison tells me that not only is NVIDIA coming through for investors, but it has some kind of competitive advantage, allowing it to charge those higher prices, get better deals, and drive that durable return for your money. And then something most investors avoid, asking the simplest question: why is the stock up or down? Is it a matter of great management, a good product, or just a rising tide and a broader theme lifting all boats? Shares of memory chip makers Micron, Seagate, Western Digital, and SanDisk are soaring on AI's insatiable appetite for memory, but these four companies are not created equal. Memory and storage is an extremely cyclical industry, and I guarantee when that cycle turns lower again, we're going to see which are the great companies which were just swimming with no clothes. But on the flip side of that, a stock down on an industry wide challenge might still be a good investment if those challenges ease. Major names in the packaged foods industry are all down and closely correlated. Now that tells me it's not just bad management at any one company, but an industry wide problem and maybe a buying opportunity in those with better management. On making sure you actively seek out the bear case analysis for a stock, why some people are selling instead of buying, along with watching for these trends and the fundamentals, won't make every stock a home run, but it will improve your hit rate and will make you a lot of money. Check out the investing sites I use and get your cash back and free shares with the special promotional link I'll leave in the description. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.